My name is Eric Smanis. As you can see by the slide, I wear two hats. One of them is I'm founder of a company called Half Solved. It's actually a new chapter in a book that I've been writing for crazily now 27 years. I was explaining that if some of you know Mark and Monica from the center, we were all together in Chapel Hill back in the 90s. And so it's funny how our paths have still led us and kept us together. But this journey started back and then. And the whole focus of this book that I've been working on is really how do you profitably, reliably, and systematically innovate breakthrough ventures? Ventures that you can commercialize, when we talk about disruptive technologies, but new to world technologies solve problems that out in society just remain persistent. But how do we do this reliably, properly, systematically? First 10 years of that, I was actually here. So lots of those chapters were written here. And it's during that period of time I was doing my doctoral work, and we were running ventures with DuPont, SC Johnson, Ascension Health, a private equity firm, and all these ventures were there to test out and try to evolve out just this methodology. We all four failed, but we left with really what I think was kind of like this key breakthrough insight. I won't talk about that now, but that key insight then kind of led to real retooling and rethinking of like what's the problem we're solving for and how we need to solve for it. And then kind of a whole bunch of other chapters were written once I left Cornell. And I set up, I was working with a partner in London, and we were running a venture studio where we supported corporations, did a lot of work for the International Finance Corporation on Grid Solar, but we had probably like upwards of 40 ventures for Barclays, Disney, Pearson in education, BMW, UK, just more like services, Mars, Procter and Gamble, and we took this retooled methodology, this retooled art, and we just had this incredible opportunity to just keep taking it through cycles, and probably with the course of another like 8 years that passed, this approach and just the science of understanding market creation just got to a point where we felt like we can really bring out the value of it versus us trying to build ventures for people. Is like if we can like put this into other people's hands and create a capability for other people to take this science of market creation, the discipline that we've been working on, and just apply it themselves. And that's where Half Solved comes in. Half Solved as a company, we call ourselves a venture design and engineering firm. And our mission is to build a capability in entrepreneurs, corporates, investors, in applying the science of market creation and this discipline, which will literally just introduce at the most briefest level, called integrated venture engineering. And it really harnesses key engineering methodology from systems engineering. We have Cliff Whitcomb here from systems engineering. And anyway, we'll pause and like I said, that's a whole nother story. We're not going to get into solutions today, but today is really just about defining problem. And that's in part why we call ourselves Half Solved. There's this famous Charles Kettering quote, who's the R&D lead for GM, that said, a problem well defined is a problem half solved. And I feel like literally the last 27 years have just been about trying to define the problem. And every venture that we run continues to improve our understanding of what is the problem. Second hat I wear is this director of the Market Creators Lab. I'll talk to it in just a minute, but the Market Creators Lab is actually why we're here today. What we'll be sharing out today actually comes out of a research project that we undertook, one of the first ones that we had. I'll go click it on. So the Market Creators Lab, and this is actually set up in part to fulfill kind of this mission of bringing out the capability. The lab itself is a partnership between our firm Half Solved, Cornell, CSGE, and then with INCOC. INCOC is the International Council on Systems Engineering. So it's the large systems engineering professional body that's responsible for taking, taking practices of systems engineering, creating credentials around it, applying it to other fields, just advancing the discipline and sharing it out. And so the three of us together have come together to create this lab. And the purpose of the lab, it's to convene people. It's to convene entrepreneurs, corporates, investors, people from the venture building space. But the goal is we want to keep forwarding the science of market creation. And the whole structure of the lab, it's a highly applied structure. We have entrepreneurs in residence. Mark Eady here. Mark, I'll let you introduce yourself just a sec. But Mark was our first entrepreneur in residence that joined us last year. And a key part of the lab is that we're constantly trying to build ventures and using those ventures as live cases. So we're building ventures, applying the methodology, and constantly trying to use it as a way to push forward methodology, and also to provide live cases for others to learn from. So let Mark introduce himself.
Yeah, Mark Eady. I finished my professional master's in systems engineering last year. Prior to that, my training was in neuroscience and business, and I worked biotech R&D, corporate development, ended up with a couple of different venture funds in the biomedical digital health space. And yeah, found it very challenging. A lot of the disciplines we were using didn't feel like disciplines in venture capital. So I was excited to meet Eric during the systems program. We got together, a lot of resonance. So yeah.
Awesome. Great. So the lab itself, it's run through kind of a key structure of it is using working groups. And working groups are member driven by applying the science as well as this methodology, integrated venture engineering, to like really specific questions. Like if you come from nutrition or health, or you're coming from a certain sector, or you're looking at certain technologies and say like, what uniquely kind of changes? How do we adapt? How do we have to think about these things from the lens of that specific question? And let me introduce at the same time, Fuzi Singh. Fuzi is a venture fellow. He actually was instrumental in doing a lot of the legwork behind some of the numbers we're going to dig in today on this research question. Fuzi, why don't you go ahead and introduce yourself?
Yeah, hi, I'm the MPS accounting student at Cornell MPS program. So the kind of thing inspired me to join the Ezra group is of my family business. Confronted a lot of the same issues we can't solve. So that kind of inspired me to join the area to engineer the good way to systematically to tackle those problems. I got several internship in private equity and VCs. So kind of leverage my skill to build up models to like quantitatively reflect the problem and solve it. Thanks.
Thank you. Yeah, so he really hats off to Fuzi because he did some serious digging around from some old filings in order to be able to recreate some financials for us. All right, well, let's kind of kick into it. So the research question that kind of sits underneath what we're looking at today, it came out of one of our three kind of starting working groups for the MCL, which is the evaluating early stage ventures. And the question was like, well, under what conditions does lean startup make financial sense as an innovation method? And I'll give a quick little thing on lean startup because lean startup has become, it's truly like a paradigm. Even if you think you don't use lean startup, you probably do use lean startup. And the key principles of lean startup starts with the idea of like, look, building completely new ventures, targeting, bringing functionality that doesn't exist today. It's just this extreme uncertainty. Like you don't have any customers to research, you don't have a business model to benchmark off of. So there's just a bunch of unknowns. And the other key kind of element of lean startup is this idea of like the very process of trying to come up with a model. It's a search process. And you'll see in a bit here, like how they go about doing the search process. Maybe the key concept that's the most popular that came out of Lean Startup was that of the minimum viable product. Everyone knows about the MVP. This is what I mean. Even if you don't know you use Lean Startup, you probably are. So everyone is building an MVP. And the very idea is like, look, because of this extreme uncertainty, just get out, start talking to customers. You know, the saying is get out of the office. You know, talk to a lot of customers, just get an idea of what the problem is. And then instead of trying to come up with this fully baked solution, spending a ton of time detailing something out, because when you're dealing with so much uncertainty, you know, at the end of the day, there's just a bunch of assumptions. And so the way to deal with that is create a minimum viable product, spec it out to the least amount you need to kind of get going, and then get in the market. Get in the market and start selling this product. And the three kind of key principles of this are like, just start experimenting. See this as an experimentation process. That's what the search is. You're experimenting, you're testing different formulations, different ways of presenting the product, different value propositions. And by testing in the market, you actually get real customer feedback. You know, you're not talking to people who say, yeah, I'd like this. But then, you know, when push comes to shove, they don't actually tap the payment with their credit card. And so taking all that customer feedback, and then you're in this iterative process. You keep updating the product, putting a new one out there, seeing how customers respond. And the idea is that eventually, you know, you'll get to the point where they call it product market fit. like you've kind of found that sweet spot where customers are really like, yeah, this is what I want, this is what I'll pay for it. And so you know you got product market fit when you've got a growing base of customers who keep repeat purchasing the product. If you get to that point, then it's like, all right, now turn your attention, start experimenting, testing, and work on the business model, get this thing profitable. Look for ways to optimize, look for ways to, yeah, go ahead.
I'm just curious, because you seem to know a lot about the origins of this whole lean startup paradigm, as you call it. Does that term product market fit also originate with this lean startup paradigm?
Yeah, it's part of that whole family. Yep.
Okay. Because I feel like it's kind of become, I mean, I guess in a similar way as MVP, just very.
It is. Product market fit, I guess.
Yeah.
And the third term that sits in there is that of the pivot. Because if you're doing this thing up top, and you're doing a whole bunch of work and it's not working out, cut bait, start over. That was the reason for doing an MVP, not going and spending a whole ton of time. But pivot, go back, rethink the problem. Maybe you got to look for a different problem altogether. Maybe you started the wrong problem. But follow the same approach. You know, you go through this loop of MVP, testing, experimenting, updating the product, and then ultimately, again, if you get to product market fit, now's the time to start saying, like, now let's get this thing optimized and profitable. Any questions or anything about that? Because what's different people kind of hold on to different things when you say lean startup. Some people really focus on the idea of, oh, it's really just about talking to customers and getting out of the office to get to that MVP. So there's this design thinking element. Some people anchor in more. For other people, it's this idea of the rapid experimentation. The idea of like you're out there, you have a hypothesis, you test it, and you feed it back in.
Fail fast.
Yeah, it's a fail fast. Exactly. Okay. But so like the essence of lean startup, kind of when you think about how we're going about solving for the problem of coming up with a profitable business at the end of it, it's kind of the proverbial, you're gonna build the plane while you're flying it. And again, why they're doing it is because you're trying to get good customer data. So there's a logic to it. I don't mean this as a pejorative, but like get out there, because otherwise you're sitting in a lot of abstraction. But it's build it while you're flying it. That approach, this isn't explicitly stated, and that's why I call it, there's these de facto investment parameters on which that approach and way of solving for a business brings into play. The first one is, it's just inherently has an extraordinarily high failure rate. Because at the end of the day, they're not trying to like solve for the uncertainty. They're just like, this thing's crazy uncertain. You just got to experiment. Just keep experimenting. So we're not trying to like figure out and come up with a better way to solve for it or crack the code, so to speak. So like, you're going to take a high level of failure. So Venture Genome, there was a report that came out the past couple of years. Their research over all these startups of the past 10 years looking at accelerators and incubators was 1.5% will get you an exit of 50 million or more. 1.5%. But exit doesn't mean you're profitable. So 1.5 are getting an exit. If you just use the proportion of companies that actually exit and what proportion of those are profitable, less than 20% actually get to profitability. So if you start with 1.5%, now take 20% of that. It's a really small number that actually figure this out. So that's the first parameter. The second one is this very way of trying to experiment, like while you're running the business, where the cost really comes into, it's not in building MVP, it's running inherently a loss-making business. That's the essence of it. It's like figure the profitability out once you get product market fit, but you're running your business and trying to figure out how to be profitable. So it's like, it's a business model R&D process that's happening. There's a misnomer. Sometimes people think, oh, that we just need working capital. It's like working capital is what you do when there's a mismatch between your what you charge someone and how much you have to pay to get the product. This is not that. It's working capital when I'm profitable and I know that eventually the money will come back. This isn't working capital that's being spent. This is R&D funding, and it's a very different idea. Last thing is the timeline. This way of building, this way of solving for it, it's inherently long. I mean, you look at Bezos, everyone's like, this is a 10+ year period. This is not something that you're going to search and find in a really short period of time. I think right now there's somebody at the University of Florida, a finance professor, that does a ton of work. He's got this massive database on IPOs. And I think the average age of the companies that all IPO'd over the past 10 years are all sitting at 13 or 14. And again, less than 20% of those are profitable. And they've been running for 13, 14, 15 years. So back to the question, like, under what conditions then does it make sense to use lean startup as an innovation method? And it's, just share a quick story. Watch my time. Share a quick story. Like, we came to the conclusion, said, you know what's would be a really interesting way to really kind of probe and understand that is to actually take what everyone considers probably the greatest success story from lean startup, and that's Amazon. Amazon is truly, like, when you talk about the black swan event, it's a company today that is, I think they're top 5 in market cap in the world. But it is, if there's one company that ultimately gets brought back, say, like, but this approach birthed Amazon. And it truly is incredible. We were on a call with a group of corporate and innovation heads. And where this idea came up was there was a person from Amazon who was sharing out and was explaining kind of the importance of, you got to fail fast, rapid experimentation, you got to pivot, you got to accept these losses. And one of the people from the corporate said, it's just really hard to swallow that. And it's really hard to communicate that internally. And his response was like, yeah, I know. He said, but just remember, you could have created an Amazon. And it was that question or that kind of statement that got us asking, like, well, how successful is Amazon? You know, I guess, how great a return is Amazon? And so what we did is we went back in to really kind of unpack the numbers. The beauty of Amazon is it's 30 years of cash flows that we have. And we'll, did everyone, you had, I'll highlight something that's really valuable about having 30 years of cash flow data to understanding kind of the challenge that we faced. But so we came back in and said, all right, well, let's take a look at this. And now Amazon, founded in 94, 9 years to reach profitability and operating profits. So this is not counting taxes and all these other one-off costs. 1.9 billion in operating losses approximately over that time. But coming out the back end, they got 13% share of all e-commerce, global e-commerce. And that is a $6 trillion market. And then, as everyone knows, the other big piece is cloud computing. They're now 30% of global cloud computing, which itself is, you know, a $750 billion market, rapidly growing. So how big a success is it? I guess the answer is it depends. So let's take a look at it from a VC fund perspective. Kleiner Perkins, you know, one of the big players in the space. Kleiner put in 8 million, I think it was in 95, exited, had a total absolute return of 55,000% on that. You turn that into an IRR, it's about 3,700%. Pretty good. I mean, this is, and it feels right because you look at what this company is today. This is literally, it's a once in a lifetime event. Key thing to remember here is when they actually kind of cashed out, Amazon had an operating loss of 680 million. And they had about, what, 850, they were approaching $1 billion in accumulated losses. So we asked the question, I'm like, well, all right, that's a VC, but what if you actually had to hold this? What if you actually were holding assets? You think of Amazon almost as like a cash machine. Someone says, look, here's the cash machine. You pay the losses while they're coming, but then it's just going to ring the register. So you just hang on to it. So much like a corporation would, like a company, you know, it's not going to go and exit their, you know, what they start out. They're holding for cash flows. If you're an entrepreneur wanting to build a venture, maybe you're thinking, you know, I'm going to sell this, but a lot of entrepreneurs are like, I'm building a company for myself. So you're holding for cash flows. So how does this thing look actually from a cash flow perspective? And I'll pop this over to you guys. So what would you think is the average annual rate of return? So the IRR. So the Kleiner Perkins was sitting at 3,700. What would be the IRR for Amazon if you looked at our 30 years of cash flow? We tacked on a terminal value to it of all the future cash flows that keep going. What do we think that IRR would be? And I'll say, I've got you. You know, it's one of these decimals of 32. Is it 3.2%? Is it 32%? 320 or 3,200? Any intuitive guesses?
Either C or D for me, because it's like a very stable business, just printing cash like into the future.
Yeah. Totally. Okay. C or D? Anybody else?
I'm gonna go with 32 just because.
Same.
Yeah, I'm setting them up.
I'm going with B also.
And 32 sounds great, except that it's this black swan event.
Yeah. Uh-huh. It is. It's 32%. And 32%, it ain't bad. That's a really good return to have. That's 30% every year I'm gonna get on my money. It ain't 3,700%. But 32% is like, that's a nice return. Is it a return that you expect from my black swan? Sorry, it takes me a while to go back. My black swan event with a $1.8 trillion market cap that has 13% of a $6 trillion global market and a 30% of a $750 global market. Like, doesn't that seem really underwhelming? And to put that in context, so if you look at other IRRs, these are benchmark IRRs for different kinds of projects. Operational efficiency all the way down to like doing kind of like energy retrofits in your company. So this is what the CFO in the corporations is looking at. This is what they're actually thinking and shooting for. So yeah, 32%, definitely better. Again, if I can squeeze out of a 25% of an IT one, and you tell me it's 32% for Amazon, again, it feels pretty underwhelming. Feels confusing that it would be like that. But there's actually more to the IRR story, and that is that 32%, that assumes that we had a crystal ball. That assumes like, I'm going to buy Amazon, or I'm going to start Amazon. I'm going to pump out 1.9 billion, and it's going to give me all those cash flows. I will have a 32%. But if we go back to our previous slide about the investment parameters, like these ventures have less than 1% of ever getting to profitability. So if you're going to in order to get the one Amazon, you're going to have failures. So I put up here 3 levels. Like, let's assume you have a 10% venture success rate, which is really rosy considering the venture statistics. But so like, we've got to have 9, we got to lay 9 eggs in order to get one black swan. Now, if you lay 9 eggs to get the one black swan, we're down to 21%. If you're at 5%, where I'm going to have to lay my 19 eggs to get to the one, we're sitting at 18, and then down for the reality of the world is today at 1%, is I'm going to have 99 failures. We're down to 14%. So it's a really interesting thing once you start looking at, again, like this way of building has has become the paradigm, but it's because we've seen these unbelievable returns. But again, those returns are coming for a really certain reason, and which we'll talk about in just a bit. Any questions or reflections on this? If I could ask one reason why I was really keen to look at this Amazon was because if you look on the top of this, you have to look on the second page. I know this is an eye chart test, but on the top of the second page, this is what I call the crystal ball results. And you look at year 30, I've marked it in blue. That is where we are today, or I guess last year, 2024. And I'm saying to do without my glasses. But you see what the IRR is? The IRR is sitting at 27.38%. And then basically what I did is then we ran out the calculations all the way for another 30 years, just to say like, because you have to capture that value. And I assume this thing's going to keep growing. Your operational profits will grow at 15% annually for another 30 years, which is an extraordinarily high number.
So are we looking at crystal ball, rosy, stretch,
Yeah,
or reality?
crystal ball. Look
Okay.
at crystal ball, that top one.
Yeah.
And yeah,
2024, you said?
and then 2024, you'll see year 30, it's
Yeah.
27.38% in green. But look at year 60, with that continued growth, that's where at our 31.63. Yeah,
Is it not a fantasy? what kind of corporation lifetime value, and I'm talking corporate lifetime,
Yeah.
not the value that it gets delivered. How many corporations or enterprises do we know that are still alive
Yeah.
30 years after the inception of
Yes.
plus, right?
Yeah.
So is this some kind of an outlier, if not a unicorn of imagination?
Uh-huh. Well, this is, are you saying like, is it even forecasting out another 30 years?
Right, like,
It's absolutely very
is it
risky.
a fantasy complete? Because history
Exactly,
tells us that
exactly.
no company survives. more
Exactly.
than
Look at
X.
GE today.
Right, exactly.
Yeah.
The IBMs and,
Yeah.
and everyone else.
And that's why I wanted to highlight this was because you see how little the IRR changes from year 30 to year 60? And it's the beauty or the beast of time value of money. Once you get to 30 years, I don't care how freaking big you get, like you're not gonna fundamentally move this thing. Like it is all sitting in, the first 30 years of cash flows. That's what makes it so different when we're, evaluating a company in 5 years. Because typically at about 5, 6, 7 years, like 90% of all your IRR sits in what we're calling kind of the terminal value, with all the future cash flows. But that's what makes this a really interesting thing to look at. But to your point, it's like, wow, even that, like, so when I say it's a 32%, like, that's quite generous, actually. Like, you're somewhere between 27 and 32. All right. So the VC funds, however, like we saw, like, at least, and that's why I put in there, it makes financial sense, or it has made at least. Times have changed. And a lot of these deals were happening when interest rates were quite different. And there was a very different, sense or urgency for profitability than there is today. But it still makes sense for VCs. You see the returns you're generating. But again, like what makes it feasible and actually the right strategy for a VC fund is like they're going to place a lot of bets. Like if I have a less than 1% chance of rate, like you're placing 50, 80 bets. You've got a $300 million fund, $1 billion fund. You're placing a lot of bets. One of these things is going to pay off, but you have to have that ability. Will a company place 50, 80 bets? No way, impossible. But the even bigger one, that's one piece, but the even bigger one, the thing that makes the whole thing work, and that's why there's for those who recognize the Monopoly card, the get out jail free card, the thing that makes the whole thing really work is the ability to exit and sell a venture off at a multiple of revenue while they're still in profit. A VC fund has a lifespan, 10 years. You're going to be holding that thing. If you follow the first 5 years you're investing and the last 5 years you're exiting, maybe you have 5, 6, 7, 8 years. I know the time has lengthened some, but you're going to exit. And if you look at, what we were seeing, like the length of time, if it takes more than 10 years to get profitable, you're going to be leaving this thing when it's profitable and accumulating losses. And so how do you assess, profitability? Everyone's using multiples of revenue. And so what you're doing when you exit with a multiple of revenue is you are capturing today all of those future cash flows that are still may or may not happen. So it's like you're shortcutting the entire process by being able to exit. And that's what makes it, that's why it's working. That's why this is what I feel like is this massive misconception that's happened around the space of lean startup and VCs and why this asset class is actually really focused on lean startup. Is one, it is not an innovation strategy. They're not using this approach because they're saying like, this is the right way, the best way to come up with a profitable company. They're not solving to come up with a profitable company. That's not the goal. It's an investment strategy. And it's an investment strategy for the fund to be profitable, not individual companies. They've separated that requirement from the fund. Yeah.
So it's not important for a company to be profitable, right? Because, we can generate returns like you described in the process. However, if I am a devil's advocate and ask the question, how many of these companies that, for example, went into this research, the Amazons of the world, right, and other startups, the eBays, how many of them truly, if we interview the founders, we ask them about lean launchpad methodology, that they even knew what that is, right? And have they followed anything remotely, or they say, you know what?
Yeah.
I think we need to create this
Yeah,
e-commerce store that sells books.
yeah,
All right, and I'm gonna type it while you drive to the West Coast,
yeah,
right? In a Honda, all of a sudden, right, we have this unicorn and another unicorn and a unicorn.
yeah.
Is there a correlation of lean and VC, or is it something else?
Yeah, it's because I guess the question is always like, is it art imitating life or life imitating art? And I mean, Eric Ries's, somebody might know better than I do. Eric, well, Lean Startup formally as a concept, maybe 2010,
Yeah.
something like that. Obviously, Amazon preceded it. But like where the ideas came from, that became, everyone was looking back at digital software. All the examples that if you go into the Lean Startup book of like Rocket and all these other companies that most of them don't exist today, that are all like the success stories that were explaining like, look, this is how we quickly got out of the market. This is how we were able to grow, you know, in this very different way. But so I think this is where you're absolutely right. I don't think like Bezos wasn't saying like, I got to use the Lean Startup method because it didn't exist. The way he thought about it and the way he approached this, it probably was one of the first that really, like I said, broke the mold, that kind of opened up the space and became a reference point for others that then became Lean Startup. But it was not, like I said, it's probably the thing that actually properly legitimated it.
No, I don't disagree because the first startup failed.
Yeah.
My second did because we were solving a problem, which is totally lean startup before lean startup existed.
Yeah, yeah.
Right, solving a problem, going on research
Yeah,
and finding what the feedback from the customer they're willing to pay for. So totally.
yeah. And again, like the part that I think, well, like I said, well, you'll have to come back for another session when we talk specifically about, the integrative venture engineering. But again, like there's elements of this overall kind of paradigm, this approach, like the idea of like talking to customers, getting out and talking to customers, instead of trying to bake something completely inside the lab, that's not, quote, the problem. Like it's kind of the entire thing together. There's a couple of key things that really make, I feel like I'm trying to open up the thing. There's a couple of things about the approach that fundamentally set a venture up to fail or make it really difficult for a venture to find a path to profitability. But again, I'm going to direct you at the end of this to some resources that actually will explain that. And we'll talk about another session where we're going to get into that. But I don't know if, yeah.
I think Gus had a question.
I
Yeah,
just wonder, I think, Felix, I think the reason that Amazon is such an interesting case study here is because their corporate culture over time sort of took on the lean startup method. Not at the beginning,
that's a good point. Yeah.
right? It wasn't at the beginning
Yeah.
necessarily, but their fail fast thing
Yeah.
that's kind of their mantra, right? And
Yep.
sure, it's worked, but again, it's a total outlier for most corporations can't do that.
And when Eric and I talk a lot about, there's a philosopher of science, Thomas Kuhns, he wrote this book called The Structure of Scientific Revolutions. He invented the concept of paradigm shift.
Mhm.
So even before something becomes a formalized method, it's still percolating. The normal science of
Right.
innovation is lean startup.
Yeah.
And before it became formalized and principled by Eric Ries, it was still the water in which everybody was swimming.
Yeah, got it.
Yeah, because there was the stuff that he built on, like this idea, there's a whole strategy approach called discovery-based planning by Rita McGrath out of Harvard. And that's this, and there was also another a financial concept that was applied to business strategy that was like using for God's sake, real options approach, applying a real options framework to making strategic decisions. And so there was already kind of sitting there, kind of this way of thinking in the 90s that then kind of, you can see where it became the foundation for this. And then, as we all know, like IDEO kind of burst onto the scene, must have been around 2001 or so, and the whole human-centered design field. And it's kind of these things that kind of, these threads that came together to like make Lean Startup. But we'll come back to your point of like, now they're actually like really full-blown Lean Startup. But there's, like you said, actually they can't use it is the problem for this reason. I got the wrong one. But so this is the final point of like if you're working within these kind of investment parameters, like the whole push for growth, again, why they're pushing for growth, and they have to push for incredible growth. Because if 1 out of 100 is gonna succeed, 99 are gonna drive up a massive, blow a hole in my balance sheet. I gotta have, and I'm going to be exiting on a revenue multiple. That revenue multiple and that revenue line better be huge, because it's the absolute contribution margin, if you will, on that exit that's gonna cover everything else. So it's like you have to push for brutally fast growth using this approach. And for me, it's almost like a bit paradoxical. It's like you are digging such a big hole that the only way to get out of it is by having literally a black swan event. That's the only way you could get out of this hole, is kind of this key point. Like when you dig so deep, you need a black swan event for this thing to work. So it's kind of like reinforcing the those investment parameters just almost like get reinforced through this whole process. But, the reality is like, for most people, for everyone else, like cash and profits actually do matter. So if you're going to take this way of building ventures, like it's going to set you up for failure. And there's two entities just in, obviously, like a self-funded entrepreneur. Just think about that. Like, yeah, what are you going to spend? Maybe if you're going to do a tech product, you get 20, 30, 40K in order to get an MVP out the door. But then what? Like if now my strategy is to absorb losses while I'm trying to get to product market fit so I can get my next round of investment, and I'm losing 40%. I'll show a thing. That's really typical. 40% in the beginning. So if I got 100K of sales, I got 40,000 now. I've got to fill in with I got to find how to finance that. And the whole thing is like the faster you grow and the more you're trying to show product market fit, the bigger a hole you're creating. So you're caught in this bind. And there's all this research that always shows like why entrepreneurs come from really wealthy families, because at the beginning most is self-funded, and you kind of have to in this way. And so it's really tough on an entrepreneur who's starting this off. And then the other actor, which seems surprising, is corporations. Even the biggest corporations will struggle to do this. And it comes down to this key thing of like corporations at the end of the day, stock prices. I know there's moments, there's times when this gets uncorrelated, but at the end of the day, it's your growth in earnings that is what keeps driving a corporate stock price. That's why the CFO, keeps coming back and looking, saying like, when is this venture going to be cash flow positive? Because every year that you're taking off losses, all you're doing is you're chipping away at the very one metric, the one KPI the CFO is managing for, which is my growth in earnings per share. And it happens so quickly. And I created this chart, and I'll make it. It's actually in the paper, but so this just shows how that this two tables. Table one is just the losses that are sustained if you're using this search approach, looking for a profitable business model. And I tried to get some industry benchmarks from the companies we work with, and then also just pulling up how typically it happens. And so over here on the in the top left, the way the model works is like, it assumes that for the first 4 years, you're going to grow at about 100%, kind of the big growth that happens initially. And then kind of years 5 to 8, you're at 40%. And then the next two variables are how big is the loss? If you figure at the beginning, I'm going to get 40% and I'm going to squeeze the loss down to 20%. Again, these literally are pulled from like industry averages that in the startup world. So if you look at then what happens over here. So in year one, for example, I started this off as saying like sales of 5 million in year one. In a corporate context, like that would be just very, if I'm in a corporate that's 15, 20 billion, I'm going to get to 5 million in sales the first year. Okay, that's nice. That's nice. But their aspiration would be, a lot of the companies work with said, their big bets were always typically like, we're looking for 50 to 100 million new revenue opportunities. So in year one, you got to be somewhere around like 5 million. You got to be in the low single millions. But so on 5 million, what this is saying is like, you're going to have 2 million in losses, i.e. 40%. And then it just keeps tracking down there and following the accumulated loss. And then down here, it's just saying like, what is the implication for how much it reduces earnings, the profit growth targets that the companies have? And we picked the starting annual net profits over here of 250 down to 2 billion, 250 million to 2 billion. That represents, want to say 40 to 60% of all Fortune 500 would land into there. So this is Fortune 500 companies, that kind of a level we're looking at. And so we look at, and if you have a 10% profit growth, and typically companies would be 10 to 15% profit growth targets that they're managing for every year. If you're starting with 250 million, and you need to have 25 million additional profits that are coming from some new stuff that you're doing. And so you'll see here, like year one loss. So the idea of like, if you're shooting for 25 million in additional profits, and you have the 2 million loss that comes from the ventures you're trying to build, basically you've eaten up 8% of that. Yes, doesn't sound bad. You know, that anybody, the CFO at the level of seeing that, you know, all the work that they've been doing to push that number up is now being eroded. But yeah, it's not going to kill you. Year two loss, suddenly I'm up to 4 million. At 4 million, you know, looking at the 25, that's 16%. This is starting to get significant. And this is a 250 million, this is a company with profits of 250 million. So you're talking about if that's a 10% profit margin, we're talking about a $2.5 billion company. So a $60 million loss in year four for a $2 billion company who's trying to grow their profits by 25 million, we just burned 64% of what they're trying to achieve. So these numbers, this is where everyone says, yeah, but they're $1 billion company. Certainly they can absorb it. You'll see here, everything that's in the light yellow, that's, I think, a 5 to 10% bite that's been taken out. The orange is 10 to 20 and the red is 20 to 50. Like if you're up in the red 20 to 50, it's like you do that for a few years and you're going to have a change of CEOs happening. And you see, and just from my experience, and if anyone's worked in corporates, like the appetite for these things, year four seems to be 3, 4, 5 is where like these things get shut down. And whenever they get shut down, people are like, oh, why can't we just be more patient? This is why you can't be more patient. You can't be more patient. It's not like something wrong with the company. They're equally effective as entrepreneurs in using lean startup. I think the mistake people make is they think, wow, companies just can't, they're not flexible like entrepreneurs. Like, no, they lose money just as easily as these entrepreneurs are losing. It's just, it actually matters to them. So the key takeaways, you know, and it really is, it's about, you got to align the method, the way you're building ventures with your investment constraints. And if I just put these in, so like from the standpoint of anybody who depends on cash flows, pay bills for their profits, for their return, the real cash flows, not potential future cash flows. Like you can't use this approach. It's just not, it's not meant, again, to innovate within those financial parameters. You can exit a company making a big loss, then this can work. And if you're actually in the other world, where it matters, you've got and again, this is not rocket science, like you've got to change that probability of success. Like a 1% probability of success is just going to make doing this type of venture building becomes impossible for anybody who, if you're a corporate entrepreneur, you can't do it if you got a 1% chance of success. We've got to have a methodology that's solving for it versus saying, well, that's just the nature of it. We'll just accept it. We're just going to, put a bunch of bets out on the table. And then the other piece is, it's basic finance 101. It's time value of money. The longer you take to get to profits and the more money you burn in the process, the harder it becomes to get this thing to be IRR positive. So you've got to figure out we got to cut the cash. We can't be experimenting, absorbing a 40% loss once we launch a business and doing it for 10 years. We got to figure out a way to get to a profitability much quicker. And the last piece is we got to shorten this time frame. It can't take 10, 15 years before you start getting positive cash flows coming in, because the value, if I pop you over onto one more thing, this is what's always it's just shocking. If you go to that same one of the year at the top, year 30, Amazon's year 30, and it's 2024 year 30. They had operating profit of 66,000 in millions. Wait, that's 66,000 in millions is $6 billion. Yeah, so they have
56 billion.
66 billion, yes, 66 billion. So they had operating profit of 66 billion in absolute terms. But go down to you can't see the thing, but the line that is underneath the dark one that says 1692, right above the green, 1692.
Yeah.
That's actually the present value of those cash flows. In other words, that value, because of time value money, 66 billion in 30 years from now, in today's money is 1.6 billion. It's like the value of money that's coming in the future, once you're in the hundreds of billions, like it's just worth pennies on the dollar. It's 1/66 the value of it. So that's why, again, like to have any meaningful impact, you have to have extraordinary numbers. I'm not, from a timing perspective, I could pull out, we looked at Uber's numbers. I'm gonna, just because I'm so excited to share. I just want to show you Uber. Uber for me is the one that it just blows my mind. Uber, you saw Amazon numbers. Uber took 12 years to get profit growth. Amazon lost 1.9. Uber's lost 35 billion in accumulated loss. And what are the markets that they have? They've got 22% global ride sharing, which is 160 billion, not 7 trillion. And they got 30% of global online, which is 250 billion, not 750 billion. And they're only, I think we got 14, 15 years of cash flow. But, and this is what, again, for me, is just like first round capital, again, famously, 1.5 million exited with 1,733% absolute return, translates into an IRR of 130%. Really good return. For Uber to be able to get to where Amazon is, I was back enveloping these numbers. So they've got to grow, this is what's crazy, is for the next 17 years, so to complete their 30-year cycle, 17 more years, they've got to grow operating profits every year by 43%. But the problem is, which translates into almost $1 trillion of operating profit in 2041. But the problem is, like, where's there a market? If you assume that $1 trillion, represents a 10% operating profit margin, and they've got 20% share of this market that they have to find a new market worth $48 trillion. Because and this calculation assumes those other markets grew at their compound. They've got like online food is growing like a 15% compound annual growth rate. The other one is growing at 18%. So I've accounted for those things growing. There's got to be a $48 trillion market out there to repay this. It's and I know this is I guess the opposite of the black swan. This is the black swan and the other one, but it's so outrageous. So I'll wrap up by just saying there is a solution for cash flow dependent actors. That's what this book over the past 27 years that we've been trying to write. And I mean that in a figurative way, but hopefully literal soon. And this approach is called integrated venture engineering. It builds off of systems engineering. It's a completely different way of thinking about how you solve, how you build. We're building for robustness so that when you get to market, you have a really wide path to profitability. But if you want to learn a little bit more about it, we've got a data room for the Market Creators Lab. There is a
QR code on one of those sheets.
Yeah, there's a QR code on it. And there's a couple of papers in there. There's a really dense PowerPoint as well. And it'll give you a sense of what this method and kind of this new kind of the new science is. And we will welcome people to join the Market Creators Lab. It's like I said, it's really, we kicked this off last year. So we're in our startup phase ourselves here. And again, the intent here is to just give an opportunity to people to get your feet wet in this, kind of understand it at whatever level of involvement you want. Like I said, we've got 3 working groups right now. One that's focused on evaluating early stage companies, one that's kicking off that's focused on health nutrition, and a third one that's looking at like tech transfer. Anything, maybe Mark, worth adding, or?
I think we should put it up for questions, and if anybody needs to get out of here, we're coming up on time. But
Okay.
yeah, I think questions.
Okay.
One of the things that's sort of remarkable in all this is, risk capital in the US is total outlier compared to other places in the world, right? It has been for the last like 50 years.
Yeah,
And that's what's been funding
that's it.
all
Yeah,
this, right? But if that goes away,
exactly.
right?
Yeah,
Not that it'll go away, but it
Yeah.
increases substantially, right?
yeah,
Then your approach is gonna become a lot more important, not just to big companies, but also
yeah,
to VCs.
yeah,
I
yeah,
think to expand on his, it's not just the venture dollars, but it's also governmental grants, people like spin-out and things like that, that significantly larger inflow
Yeah.
than anywhere else.
yeah.
So there's a win on, like on all sides.
See, so as an entrepreneur, this makes total sense to me, and sort of the logic that's been missing through my years of trying to raise capital.
Hmm.
That said, I do think to saying that lean startup is an investment strategy and not an innovation strategy is a difference without a distinction.
Hmm.
Because in effect, over the last 30 years, there's been a lot of innovation.
Yeah,
And there's just been this social contract made between startups and investors that this is wacky. You want me to grow? You want me to be profitable? Okay, well, we're
Yeah.
gonna go do this.
uh-huh.
Granted, innovation's messy, so a lot of stuff failed.
Yeah.
I think, a lot of stuff may fail
Yeah.
maybe with less dollars being spent.
Yeah.
In this approach, but I do think it's unfair to sort of say that it's not an innovation strategy.
You're absolutely, I didn't mean to say it that way. I meant like for a VC, like what the VC, like the reason they're using it.
Right, this is what triggered the whole,
Yeah, and we've had this, and this is where like when we think of from the paradigm perspective, is like entrepreneurs are responding to what the financiers are asking.
exactly.
But now we've gotten to the point where like the people who are even angel investors, any investor, we work with a ton of angel investors with like impact funds, with all these government agencies that are funding funds to be able to like support, entrepreneurs. And they're using these metrics now as well. And so we've created a system now where it's like and then on top of it, the research that's happening, research generally speaking, is typically goes and says, looks at what people are doing. If they look at what people are doing and evaluate it, they're not asking that what they're doing is right or wrong. And so now the research is like normalizing it. There was a piece of research that was looking at I-Corps, great program, but I-Corps, is the first part of a lean startup. But like there was a paper that came out by Kathy Eisenhart from over in Stanford. And, so they take 100, 200 I-Corps people and they look at it and say like, these were the things that made certain of these success, but success in what sense? All the dependent variables are like, did you attract investment capital? And so like, if that's your dependent variable, it's just, we got a circular argument happening right now.
You did
It's-
100 interviews, you got capital.
Yeah.
And Eric, you also made the analogy to buyout success rates. And we talk about like, when we say on the entrepreneur side, if we're looking at operations science, the success of doing an operational overhaul in the case of buyout and turnaround investing is the success rate is so much higher. We can't, it's hard to call lean
Yeah.
startup a science or a disciplinary science within business when it
Yeah.
contributes to a 1% success rate.
There's, and even you pick like Clay Christensen, who most people probably know, disruptive innovation. Clay had this paper before he passed, maybe 5-6 years ago, where he was like, when we see a problem that isn't moving, it's like, it probably, like when we use the term uncertainty, which is what's been happened with this space, like, well, it's just also uncertain. He's like, that usually means we just don't understand the problem. It's not that this thing is inherently uncertain and we should stop trying to solve for it. It's like, we need to solve for like what's creating the uncertainty. Like, why is it that we have why are we seeing this phenomenon? Why are we seeing less than 1%? Uncertainty to some extent has become this red herring of like, but there's some underlying reason. We can figure it out. And I think to me, that is the funny thing. It's like you go into these big, there's like all the work that's done in turnarounds, like where you got like a completely failing company. People can go into a completely failing company and they have like a, was it 30-40% success rate?
A lot higher, yeah.
It's something like that. Like a company like Apple. Apple was like literally on life support, and brought it back. So there's a systematic methodology for doing that. We got a 40% success rate. Like, why should it not work, with new ventures as well? I appreciate it's higher uncertainty. That's why I take such inspiration from the engineering field of like, you want to talk about dealing with uncertainty, complexity, missions to Mars. Like the chance of having a successful mission to Mars is 40%. I mean, you think about that number and the uncertainty and the complexity of getting to Mars. And we can do that with a 40% reliability rate. Like, certainly, we can move this thing way, way beyond minus 1%. All right, yeah.
Carl first,
Yeah.
Yeah, I am wondering how, I think that this method is applicable to maybe like cash restricted environment, you know, such as like emerging markets,
Uh-huh.
or even with like a startup founder, or even just like startup ecosystem that continuously face, you know, like restriction with having access to, because I know you mentioned it earlier as that
Yeah.
actually being something that is actually like looked at, but I'm wondering, like specifically looking at like emerging markets, right? I think where like
Yeah.
this can and should be applicable, but is there like one, like, is that something that you all have like looked at or even been interested in assessing?
Like literally my first 15 years of this work was all emerging markets. And it's all like what triggered this was this whole space called bottom of the pyramid or base of the pyramid. It was like, how does a company radically reimagine the model to be able to bring functionality to basically 4 billion people who just corporations don't serve because their income levels are too low. But how do you completely reconceive how to get mobility, health, or whatever the solution might be? And so all of the key insights from this actually came from one, because there is this incredible resource constraint in our at the customer level. But then two, we're doing it inside of a company, you know, who's pushing for profitability. And so we had kind of, now looking back, kind of the very thing that got us to see the big problem was the cash constraint that we're facing. So if anything, it's probably even more applicable, like for me, from the standpoint of for entrepreneurs to be following this type of an approach in building ventures. If you're an emerging market, if you're cash constrained, if your access to investment capital is limited, then you need to have a cash frugal way of solving this problem. And we've talked about this IDE in that way. It's really about trying to be as cash frugal. And it's just, there's some core principles, practices, tools, technologies that come out of systems engineering, which I just think literally transform how you see this problem and how you think about building a venture. So I went off your question, but sorry, you had.
yeah, no, I attempted to piggyback on that conversation, but I just wanted to try to sum up one of the big takeaways. I know that you did a takeaway slide, but essentially, corporations that are publicly traded, that depend, where the CFO is,
Yeah.
you know, his job is dependent on EPS.
Yeah.
You're saying that the lean startup method doesn't actually apply, it doesn't work in that environment because the EPS is gonna go down drastically. So how if that's a correct summary,
Yeah.
then how do we see all of these like corporate venture studios emerging, and how do they justify that to their shareholders?
So I meant to, like, well, you know, Google shut down moonshots. That's gone. Amazon shut down its whole thing because Google was losing $1 billion quarterly. That was their burn rate on all of their, you know, hot air balloons that were carrying internet technology. They had a whole bunch of plays. Those got closed down because, again, once times got where people are like, what is actually happening on the earnings level? Like, to be losing $1 billion, even for a Google, you know, it's not possible. Amazon, same thing. They cut their programs. So all the ventures that they had in this, I forgot what they call their equivalent of this new ventures type of unit. The ones that are doing, and this is what's interesting, is like, this is where the companies are trying to solve for this. You know, they're looking for a way, but the problem is we have the Tina problem. There is no alternative today. Like, what else do? You know, besides follow something that is out there? People are saying this is the better way to build. You see companies, again, we have success stories we can point to. A lot of times the success stories, again, are based off of like, again, not really understanding what's happening in the actual IRRs of the cash flows. But it's like, what else are you gonna do? And so I've worked with a lot of companies that will set up a unit, and they'll basically have 3 to 5 years. And that unit will go on for 3 to 5 years. There was one in Barclays that was set up. It was like, all right, theirs was kind of the classic one of like, let's work with fintech startups. We'll kind of rub elbows. Some of the very best of the entrepreneurs will rub up on us. We'll get more creative. So you can justify it for a little while with that. You can say we're getting insights into new technology and so forth. So there's value we're getting there. And that will carry you for about 3 or 4 years. But then you get to year 4, where all these investments that you have in these companies, you're putting more and more money in. So it's like, what are we actually getting from this?
Yeah.
And that's where, like, at some point, a lot of these corporate venture studios run up against this fundamental problem of like, where's the money? It's kind of where it comes to.
Could you clarify why the losses accumulate? That was one thing that wasn't clear to me, like why it kind of has this almost exponential like curve.
Well, it's just
losses.
literally like, it's, I mean, it's the same thing where like I've suffered a, whatever, 40% loss in year 1, but I need to, at some point, all my future cash flows have to pay back. If you think of it as, those
Like
are R&D
compounding
costs.
interest kind of thing?
No. It's just like, that's why like, what's confusing is that losses in this context, it's really like an R&D cost. And it's like, whether you do it on the front end and say, I'm gonna spend 10 years, gonna do all this work, and we capitalize that R&D cost. But this is like, it's hidden the fact that you're doing R&D all the way through. But ultimately, you gotta repay those costs. Those are sitting on your balance sheet. You have an accumulated, deficit.
But
that's
by
there.
definition, they go up in an exponential sort of way or R&D costs?
But they go up exponentially. This is where, that's why I was saying, like, by year 4, it becomes so dangerous. Because once you are growing your company, you go from 5 million year 1, and I'm growing at 100%, which everyone wants to see. Because in the beginning, everyone's like, let's see product market fit. And that's the sign of product market fit. So there's a push to grow. But the problem is, the more you grow, the bigger your losses are that you're sustaining. And that's why once you get to year 3 and 4, and a venture gets to a certain size in the company, it's like you cannot sustain the size of the loss that you'll be incurring. So it's not that the accumulated losses is more driven by the fact that like you're trying to grow your top line. So you're out there saying like, we got to grow the company. We'll figure out the business model. We got to grow the company. We'll figure out the business model while we're growing the company. And it's because there's this, we got to call
We should
it.
get out of here.
Yeah.
There's another class coming up.
Oh,
okay.
Sorry to interrupt.
Thanks.
Thank you, guys.
Yeah.